Good morning. This is the second year I've spoken at the LendIt conference. Somehow, amazingly, Christine actually invited me back after last time. But I'm very grateful for doing that, and also to the Peer-to-Peer Finance Association for giving me a quick platform here this morning. Just to follow on from Ryander's interesting presentation, he asked the question, would we be looking at this, and would the FCA be considering Auxeria's report as part of the review and the work that we're doing? I'm very glad to say we are, and I think it's an important contribution to the debate. Since I was last here, it feels like a very busy year for the peer-to-peer industry. The market's evolving, there are more players, and there are more products, and indeed there are more customers. Internationally, events in China and indeed in the US around Lending Club have brought even more scrutiny of markets that deal with crowdfunding. There have been some legislative changes, when we obviously have our own review that was just referred to a moment ago, and which I'll say a bit more about later, where we're looking at whether the framework that underpins regulating the crowdfunding industry remains appropriate and fit for purpose. But I thought I'd start today with just saying a few words about the things that haven't changed. So since the FCA introduced our regime for crowdfunding in 2014, we still have the same objectives. Our role as the regulator is to try and balance promoting competition, protecting consumers, and enhancing the integrity of UK markets. Those three objectives still underpin the logic for the creation of a bespoke crowdfunding regime in the UK, and what we want to see emerge from this market as the regulator. We want a sector that has the capacity to be innovative, for viable firms to challenge established players and established business models. And we also want them to do that without putting consumers at unacceptable risk. The framework that we apply to do that, our principles, our rules, our guidance, hasn't changed substantially since we introduced it in 2014. Now, of course, the review is going to look at whether that framework still remains appropriate, and if we want changes, then obviously we're going to have to consult on those in the future. But I'll leave that for a moment. Last year, I described the market as being a bit like a building development. That hasn't changed either. So in other words, we expect firms to be the architects for each of the houses. We expect you to choose the bricks, to find a layout that works for you and your firm, and to provide something innovative that catches the eye and stands out for consumers. Our job as the regulator is to be the structural engineer. That's the person who takes a view on the underpinning and safety of the market. Someone who says, pretty simply, you can't build a house of straw, and perhaps in a more complicated way, that certain structures are just unsuitable. Just to develop that point for a second around the idea of being the structural engineer. Last year, I also said that our authorisations process was a demanding and sometimes lengthy process to complete. That hasn't changed either. There we go. That's the first time I've ever got a laugh at this conference. But in that context, I'd just like to say a few words about our authorisations regime. Having a gateway that effectively manages risks and helps ensure consumers have confidence in the market also allows us to have a level playing field. Although it may not feel like it at the time, and I suspect for a number of people in the room given the laughter, it really doesn't feel like it at the time, the gateway can also be good for a firm, where we challenge your business models, where we pose questions about the risk to consumers, where we ask for further information. What we're doing as a regulator is trying to help you get on a stronger footing and hopefully make you better prepared for regulation in the future. It's also a very serious process. We work with firms to make sure that authorisations can be as smooth as possible. We'll try and help where we can. But it's important that firms respond to our requests fully and promptly. Ultimately, we have to make decisions to a statutory timetable, and if a firm is not able to prove it meets our threshold conditions in a timely way, then the outcome may be we have to refuse that firm. The positive news is that many, many firms are working with us. If we look at just loan-based crowdfunding or peer-to-peer for a moment, by the end of September, we'd authorised 12 platforms, and 39 were still operating with interim permission. We have a significant number of new firms also applying to get in, and since we last gave an update in March, we've had a further 6 firms apply. And of course, and again back to the ironic laughter a moment ago, we're also very conscious that authorisations represent a deliberate barrier to entry. The question we've always got to ask ourselves as a regulator is, from a competition perspective in particular, whether the regulations we have in place remain proportionate. And again, that's one of the reasons for having a post-implementation review. So if those feel like the constants, let's turn to the future and our review. One of the things that we've been considering in our post-implementation review of the regime is how the market has changed. Over the last few years, and you don't need me to really tell you this, the market has been growing considerably. When we first introduced rules back in 2013, the value of loan-based crowdfunding was 480 million. By 2015, it had rocketed to 2.4 billion. All forms of crowdfunding taken together reached almost 3.2 billion last year. However, the industry may be entering a slightly more mature stage in which growth doesn't look quite as dramatic as that, but is still very significant. And I think there's a number of factors that are in play. Growth has come in part from an increase in institutional investment. The UK Alternative Finance Industry Report noted by 2015 that 32% of peer-to-peer loans to consumers were funded by institutional investors. We're also seeing some firms explore the potential of securitisation. Now, from a regulatory perspective, that creates some interesting issues. In the post-crisis world, loan securitisation, wherever it comes from, is always going to be something we need to think about, even if it's modest in scale. And as we said in our call for input, we have an interest in seeing that all crowdfunding platforms manage conflicts of interest with great care. If institutional investors are being granted more favourable treatment in investing compared to the less knowledgeable, less experienced retail investors, we need to consider whether that amounts to fair treatment of customers and then potentially, obviously, what that means in terms of our rules. Other factors may be in play in terms of retail investors. As crowdfunding becomes better known, more talked about, as firms begin to offer new tax wrappers like the innovative finance ISA, a larger pool of retail consumers are likely to come to be investing their hard-earned cash in peer-to-peer for the first time. Now, I know that's something the industry is beginning to think carefully about. Particularly at this stage of development, consumer confidence is paramount. You need to make sure that consumers have a clear understanding and expectation of the nature and performance of their investment so that they can make appropriate comparisons across platforms or against other asset classes. I believe that is key to the future health of this industry. It's also an issue of interest to us, particularly as we look through the lens of different groups of consumers having different needs and different drives to invest. Firms are also expanding the variety of credit they offer. Hire purchase, guarantor lending and pawnbroking are already available with some sort of peer-to-peer backing, and some firms are looking to offer mortgages in the near future. Expanding into new product types creates potential risks for platforms and also raises some potentially important questions for us. Are we confident that firms sufficiently understand the risks in new markets and that investors are not being exposed to risks they are not well placed to assess in advance? Firms that then lend on to consumers and some micro businesses also have to meet our requirements on consumer credit lending, including undertaking a creditworthiness check. We want to make sure that firms don't respond to greater investment supply by lowering their underwriting standards, which could create affordability issues or increase credit risk for lenders in the future. And that segues me into the rather thorny issue of due diligence in general. Our rules are high level and they're designed to give firms flexibility of how they perform their due diligence on loans. We think that's the right way to do it. We set some minimum core standards but allow firms to innovate and find different ways to make that work. But it's absolutely essential that whatever system a firm puts in place, that does work and you're able to demonstrate that to us as the regulator. Both sides of any particular transaction need to be able to understand what due diligence the firm is going to do and what investors need to do for themselves. Marketing has to reflect the nature of the instrument. It mustn't imply there are no circumstances in which investors won't lose money. Firms must be transparent about performance and how they might use reserve funds if they have any, or any other form of financial support. We do not want to see, as the regulator, an expectations gap emerge as the industry becomes more diverse and reaches more investors. And I think it's also important that with something that's a less liquid asset, it's important that investors can act on the information available to them in a timely way. That means they have to be able to avoid unsuitable investments. They need to be able to diversify correctly, not just try and cut their losses at some point. Now, I think at this point it's worth saying much of the peer-to-peer lending industry has embraced transparency, and we commend you for doing that. But also, it's peer-to-peer firms that in our call for inputs are telling us that more can be done. Whether there's a role for us as the regulator in that process is one thing the review has to look into, and also whether the commercial incentives are there and are strong enough for all firms to keep up with and add to good practice. Like any other firm that we regulate, we expect crowdfunders to have in place systems and controls to mitigate these kinds of risks. And this set of issues is something we're looking at very, very carefully as we look at authorisation. I wanted to say just one final point on business models. And on this, I want to be absolutely unequivocally clear. In regulator speak, you have to have the correct permissions for the activities you need to do or wish to do, otherwise you could be breaking the law. In layman's terms, if you hold deposits like a bank or you want to act like a bank, then you have to be authorised as a bank. We want innovation in this market. It's something that I've spoken on many, many times in terms of how we foster and encourage innovation. But we won't compromise on market integrity or consumer protection. That's another message we've been completely consistent about. We can also help with that, though. This isn't just about having a big stick. For example, we have a new bank unit set up to specifically help foster innovation in banking. So if people have got new ideas, new businesses they want to pursue, that is absolutely something we want to encourage, but you do need to talk to us and you need to be authorised in the right way. It's also been a very noisy year for the industry. Events in the US and China have led to some very hard questions. Others have made criticisms of the crowdfunding industry as a whole. On the other hand, crowdfunding in the UK now accounts for around 2% of the small business lending market. In sub-segments of that market, it accounts for significant double-digit shares. That's funding for the real economy that matters. And it's also profitable business that other incumbents may have historically had that's being lost to peer-to-peer. So we shouldn't be surprised in the circumstances that commercial competitors should raise concerns that they face a level playing field or indeed speak about what they see as regulatory issues in the industry. It's our task as the FCA to carefully listen to legitimate concerns, but it is also our task to act only on the basis of evidence and to weigh that evidence in the round. So what next? You should expect us to complete our major authorisations work in this sector pretty soon. In terms of our review of the landscape, we expect to publish a feedback statement before the end of the year. Our objectives in doing so are going to be about getting regulation right for the sector. We want to see competition. We want to see consumers appropriately protected and successful and sustainable firms. If we can achieve that together, so that's firms, consumers and the regulator, we can look forward to an industry that has continued success. Thank you very much.